Hi, welcome to the August 2019 edition of CUNA's Economic Update, our monthly video review of market developments and credit union operational trends sponsored by the CUNA Finance Council. I'm CUNA economist Mike Schenk. Uncertainty and volatility have increased dramatically over the past several weeks, mostly due to increasing concern about tariffs and the risk of full-blown trade war. President Trump's newest unexpected threat to impose tariffs on $300 billion of Chinese goods saw equity markets decline, then sink dramatically on China's threatened response, which included halting imports of U.S. agricultural products and currency devaluation. In all, the S&P 500 lost 5% of its value in just the first 3 days of August. As might be expected, the escalation alarmed bond market participants as well, who generally saw these developments as a threat to continued economic expansion, both here and abroad. As a result, many bond investors migrated to treasuries, the safest investments on the planet. The resulting big increase in demand pushed treasury prices higher, which mathematically caused treasury yields to decline and decline dramatically. More recently, stocks have rebounded as the administration announced a delay in imposing tariffs on some goods and generally toned down its rhetoric. China, for its part, also de-escalated to an extent. And in each of the past 2 days, equities gained more than 1%, closing only modestly lower than its all-time high on August 20th. But the yield curve remains inverted. Today, the 10-year Treasury is yielding 1.57%, while the 2-year yield is 1.52 and the 3-month is 1.89. The 2.25% Fed funds target rate is 68 basis points above the 10-year yield. As we've discussed on numerous occasions in the past, the yield curve is one of our most reliable recession predictors. As shown in this familiar graphic, an inverted yield curve with short-term interest rates above long-term interest rates is nearly always a prelude to recession. And the reverse is also true. In modern times, the U.S. economy has never slipped into recession without the yield curve first inverting. In general, inversions are obvious for 12 to 18 months prior to the onset of economic downturn. So how should we interpret recent developments? Does the current inversion mean that the longest expansion in modern U.S. history is about to end? Will consumers be retrenching? Will credit union loan growth dry up? Will asset quality and ROA decline? Perhaps not. It's important to note that inverted yield curves don't cause recessions. They simply reflect economic conditions that are consistent with declines in economic output. In general, the inversions appear in mature economic expansions with low unemployment, fast rising wages, and confident consumers who are spending and borrowing at a fast clip. In these circumstances, inflation pressures are much more obvious. You can see that in this next graphic. In addition to big wage increases, spikes in raw materials and energy prices also are typical in these mature expansions. After all, increases in aggregate demand call for more and more resources to produce the products that consumers want. The Federal Reserve, by law, is required to try to control inflation, and it has historically targeted a 2% inflation rate. So as spending accelerates and those inflation pressures build, the Fed is more likely to raise rates to slow borrowing and spending. However, inflation today is within the Fed's comfort zone. The July year-over-year increase in the Consumer Price Index came in at only 1.8%, up only modestly from June's 1.6% reading. From this perspective, the economy isn't overheating, and the Fed has no compelling reason to increase short-term market interest rates. This inversion truly is different, caused not by an overly aggressive Fed aimed at slowing growth, but by flight to safety amongst longer-term investors. In addition, it's important to remember that as a starting point, longer-term yields have been, in a sense, artificially depressed. Recall the Fed's attempt to stabilize the economy in the downturn, and it included this idea of quantitative easing, adding liquidity to the economy by purchasing massive amounts of Treasury securities. Those purchases drove longer yields down and helped to grow the economy as millions of consumers took the opportunity to refinance mortgages. Federal Reserve economists and others have estimated that the asset purchases engaged in by the Fed lowered long-term interest rates by about 1.5 percentage points overall. This suggests that absent Fed action, just thinking about normal supply and demand, longer-term yields would be about 150 basis points higher than those that we actually see today, and the yield curve probably wouldn't be inverted. Of course, current conditions also are characterized by healthy labor markets with near full employment, solid job gains, and very low unemployment overall. The unemployment rate tends to be a lagging indicator of economic activity, so isn't generally considered a good recession predictor. But economist Claudia Psalm suggests that the unemployment gap, seen in this graphic, is a good alternative. The unemployment gap looks beyond the current unemployment rate, the current reading, and compares the current rate to the lowest readings over the previous 12-month period. In this perspective, you can see how this metric has shown big increases immediately preceding the last few recessions, and that the current reading is very close to zero, which would suggest a very low threat of impending recession. Zooming in on this graphic, concentrating on the difference in a narrow range of plus or minus 0.3 percentage points, gives you a pretty busy perspective, but if you look closely, you can see that a reading of 0.2 percentage points should get our attention. In other words, if the current unemployment rate is at least 0.2 of a point above the lowest reading over the previous year, red flags should go up. A reading of 0.3 percentage points reflects a very high probability of recession, and above 0.4 of a percentage point essentially is consistent with an economy that's actually in recession. Another indicator that economists and journalists often point to is consumer confidence. That makes sense. Personal consumption accounts for roughly 70% of U.S. total economic activity. So if consumers are losing confidence, economic activity will almost always decline. There are a couple of different ways we measure consumer confidence and a couple of different sources we use. This graphic shows the Michigan Consumer Sentiment Index. We have quarterly data prior to 1978 and monthly data thereafter. You can see big declines in consumer sentiment in most of the recessions on this chart, certainly in the first 4 and in the last 2. Consumer confidence has taken a hit in recent months, no doubt about that, with the government shutdown, of course, trade war, stock market volatility, and increasing uncertainty generally. In fact, the consumer sentiment reading for August came in at 92.1. That's a big decline from July's 98.2 reading, and the second lowest reading of the year. However, it's obvious in the chart that even this lower reading on the sentiment index is fairly high from a broad historical perspective. So consumers are still pretty confident, and that suggests that they're likely to stay engaged despite the inverted yield curve. As an aside, it's worth noting that the decline in longer-term interest rates could actually boost confidence as mortgage refinancings shift income from debt service to other forms of consumption activity that might make people feel even better. Having said this, it's important to remember that confidence can and does change quickly, especially if the political or economic situation changes drastically in a short period of time. In this regard, fewer rather than more tweets would probably be helpful. Of course, the employment outlook is closely aligned with consumer confidence. So it should come as no surprise that the average hourly work week, seen in this graphic, also is widely used to look for clues concerning overall health of the economy. You can see big declines in working hours precede most recessions. There are a number of false positives with this metric, and you can see that the drop-off in hours actually lagged in the 2008 recession. In any case, the declining trend here suggests that the economy may in fact be weakening. On the other hand, the ISM Manufacturing Index registered a reading of 51.2% in July. That was a decrease of 0.5 percentage point from the June level, but readings over 50 are consistent with an expanding manufacturing sector. So the decline in work hours may signal a general slowing in growth rates in that sector rather than outright contraction. Equity markets also tend to decline in advance of economic downturns. The graphic I have here is the S&P 500. I've adjusted the data for inflation so that changes in earlier years are easier to see. Equity prices are, theoretically at least, the present value of expected future earnings. So when market participants believe public company profits are at risk due to a shaky economy, stock markets generally decline. And those declines usually show up prior to the onset of recession. While equity markets have declined somewhat and volatility has increased notably, the overall level of all U.S. equity indices is quite high, and the S&P 500 is only 3% off its record high. Another intriguing signal seen here has been recently studied by researchers at the Central Bank of Norway. It's been said that housing leads the economy into recession and leads the economy out of recession. The Norwegian researchers showed that residential investment, measured by the contribution to GDP growth, is a useful predictor of recessions and has more predictive content than other often used measures such as stock market returns and surveys of consumer expectations. You can see historically, in almost every case, big declines in residential investment preceding recessions. Importantly, they also showed that residential investment and the slope of the yield curve, viewed together, are better at predicting recessions than they are individually. These results suggest keeping an eye on both before predicting a recession. Many of these individual measures of economic activity, including the yield curve, make their way into a variety of composite leading indicator indices. Again, there are a number of options from a number of different sources. But at the moment, they all tend to be telling a similar story. Here's the current view of the Philadelphia Fed Leading Indicator Index. This index was introduced in the early 1980s and includes measures of housing permits, initial unemployment insurance claims, delivery times from the Institute of Supply Management Manufacturing Survey, and the interest rate spread between the 10-year Treasury bond and the 3-month Treasury bill. It has consistently shown big declines in advance of economic downturns. If you're concerned about the inverted yield curve, the Philadelphia Fed's index should give you some comfort. It's been holding pretty steady lately, and that suggests the economy may continue to chug along despite increasing headwinds. So, in summary, a broad perspective on economic fundamentals leads us to conclude that the current yield curve inversion, which tends to be a good predictor of economic activity, doesn't, in this case, necessarily mean that the longest expansion in modern U.S. history will end in the near future. Consumers are likely to be more cautious in the current environment, but there isn't a lot of compelling evidence that they'll be retrenching. Against this backdrop, it seems reasonable to continue to expect credit unions will see decent, though slower loan growth, high asset quality, and healthy bottom line results over the next 12 to 18 months. Well, that's the current view from CUNA offices here in Madison, Wisconsin. If you need additional information on these or any topics, visit the website at www.cuna.org/economics or email us at custat@cuna.coop. Thanks for joining me, and thanks to the CUNA CFO Council for sponsoring this video update. See you next time.